Hello good people and welcome to G World Markets Academy. In our today's session, we are going to talk about the candlestick patterns. We are going to look at how a trader is supposed to make use of these very important indicators for their market analysis. There are quite a number of candlestick patterns out there which people talk about, but our main focus will be on three major patterns which, once utilized properly, a trader is guaranteed of a higher probability of making the right predictions when it comes to price movement. So what are these candlestick patterns and how are you supposed to make use of them for your market analysis? The candlestick patterns are purely used for technical analysis. Remember, there is both technical and fundamental analysis. Technical analysis focuses on analyzing the price movement in the past so that you can predict what might happen in the future. So with these patterns, you can predict two major events happening with the price movement. One, you are able to confirm a change in the trend, either a change in an upward trend or a change in a downward trend. Say, for example, price has been moving up and hits a certain point, then it starts going back. You can use a candlestick pattern to determine or to predict how the price will move. The other event is to confirm a continuation of a trend, or what's commonly referred to as a pullback. This happens, say for example, if there has been an upward movement, slight change downwards, then the price continues to move in the previous trend. So you can use these patterns to determine that change in trend and also a continuation in trend. But it is important to note that you cannot just rely on the candlestick patterns only to determine these two major events. You need to combine with other indicators. And one of those very important indicators to work with is the support and resistance. What do we mean? We mean you need to check at what point are these candlestick patterns forming. They might form at a point of no interest, a point whereby you cannot say there is a major support or major resistance. You need to look at these points first before you identify the candlestick patterns to work with. So we move now to look at what are these three major patterns to work with. The first one is the pin bar, or what is commonly referred to as the hammer. So we have both the bullish and the bearish pin bar. A bullish pin bar will form a candlestick pattern as indicated here. The body of the candlestick will appear at the upper third of the candle. It might be a green in color or it might appear red in color. But so long as it shows a pin bar, this is an indicator of a change in direction towards the upper side. And we can see this in an example extracted from an MT4, whereby the price has been moving down, but all of a sudden it's a resistance point or a support point, then the price moves back up. Once it closes, it gives an indicator of a change in direction. So you can take your position based on your trading plan, putting into consideration your risk management, then you let the price action or the price movement move by itself. So this is one of the indicators to show change in the direction. The other indicator under pin bar is the bearish indicator, whereby the pin bar will be inverted. The body forms on the lower third of the candlestick. It might be red in color or it might appear green in color. But so long as it forms an inverted pin bar, that's a sign there has been an upward trend and now the price is changing back down. And we can see this from an example extracted from an MT4, whereby price has been moving up, hits resistance, forms a pin bar, which is an indicator to confirm a higher probability of change in direction. Then you can take your position based on this indicator here. Having looked at the pin bar, we need to look at the second pattern, which is an engulfer. We have the bullish engulfing pattern. This forms when the second candle body covers the body of the previous candle. So you can see here, the first case, the sellers had the push, but all of a sudden the buyers push the price back up, forming an engulfing pattern. It could also appear whereby the wicks or the highest and the lowest points of the candlesticks are shown, but the body of the second candle covers the body of the previous. That's forming a bullish engulfer. And you can see this in an example. Downward movement hits a support, a major support, based on the lines you draw for support and resistance. And this is the pattern we are looking at, the bullish engulfer. The bullish engulfer. Under this pattern, we can also see a case whereby there is a pullback, a confirmation of a trend. So price has been moving up, there is a slight change down, then another candlestick pattern forms, which engulfs the previous candle. So this is an indicator that there is a continuation of trend. If you had your position taken earlier on, you can let it continue, or you can increase your risk or your positions based on this indicator. But again, put in mind the factors about risk management, so that in case that pattern did not confirm your prediction, then you are safe in terms of your balance, or the account balance which you have. The second pattern under the engulfing pattern is the bearish engulfer. In this case, the sellers overpower the buyers. So price has been moving up. All of a sudden, the sellers push it back and forms a candlestick which engulfs, or its body covers the previous candlestick. It could also appear as indicated with the candle forming the highest and the lowest points having a wick. This can be shown as well in a graph whereby an upward movement is confirmed first, and an engulfer comes in, looking into consideration if there has been a point of interest, which is the resistance. So once it hits that resistance, you let it run, forms an engulfer, then that's an indicator that there is a probable change in direction. It's not guaranteed that the price will change, but you need to be very careful once you indicate or you identify these points. Put into consideration your risk management factor or your risk management plan, because it's not guaranteed that the price will move as predicted. It might not, but these indicators will help you to make that informed decision. The third pattern to work with is the double barrel. A double barrel will form when the candlesticks are almost of equal size in an opposing direction. In the first one, we are looking at the bullish double barrel. The sellers try to push the price down. It's a certain support point, but the buyers come in and push it back and forms almost a perfect pattern in terms of the upward and downward movement. Remember, you need to consider the lowest point that price hit. Is it a point of interest? And we can see from this example here, there has been a downward price movement, hits a certain support point, then the buyers come in, push the price back up, and forms an almost perfect double barrel. This is an indicator of a change in direction. And still, under double barrel, we look at the bearish pattern. In this case, now the sellers come in and push the price back. Consider the point of resistance. Is it of interest? Yes, based on which time frames you're looking at. So if you see this kind of a pattern, forms at a point of interest, major support or resistance, and you need to look at which time frame are you working with. If you see that, it's an indication that there is a probable change in price. You can see from this example here, price has been moving up, hits a certain resistance, the sellers come in and push it back down and forming an almost again perfect double barrel. This one will be an indicator for you to take an entry. So having looked at those three important patterns, which is the pin bar, the engulfer, and the double barrel, and as we have said, you need to factor in other indicators, support and resistance, and you also need to look at which time frames are you working with. Are you working with the higher time frames, that's the weekly, daily, or the 4 hours, or you're working with the lower time frames, 5 minutes, 15, or the 30 minutes time frames? Because that way it will help you to know if you are looking at the long-term movement or you're looking at the short-term movement. Combine this factor or combine these patterns with other indicators, because it's not always a guarantee it will move in the direction you have predicted, but the probability increases. Remember we said you need to increase the chances or the moments when you are correct in order for you to always be on the positive. But if your negatives are more, remember you're not in business. That brings us to the end of our discussion today. And for further discussions about the candlesticks and the patterns which you can work with, kindly engage us through the numbers on your screen, and we'll be happy to help you on how to make the technical analysis. Kindly leave us a comment, subscribe, and hit the notification button so that you'll be notified once we release our next video. Thank you, and bye-bye for now.